Hello, everyone. It's Friday, June 16th. Welcome to the Final Bar. We are going to wrap this week. Leadership has really thrived this week until Friday, when we see the leading stocks, the top performing sectors rotating a bit to the downside. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the best practices of technical analysis. The technical toolkit is really empowering individual investors and advisors and even institutional investors, I would argue, to best appreciate the lessons of market history, to apply what we call the truth serum to the markets. A lot of things we assume are true, the charts actually tell us what has played out. Helps us understand how dynamics can change and focus in on the importance of inflection points. I would argue we might be near one of those really key inflection points. We've seen a small group of stocks, big mega cap, well-known stocks. However, they've really had an incredible run. They've powered our major benchmarks higher. We've eclipsed every resistance level we've put in front of the S&P and the NASDAQ. But all of those names have really started to look overextended. Look at the momentum as measured by something like the RSI indicator. Look at how far a lot of these stocks are away from their key moving averages. These are the signs that things have been a little overextended. And what that probably tells you is we're setting up for a bit of a pullback here. Now, we have a holiday weekend coming up with the Juneteenth holiday on Monday. We'll see what happens as we reopen trading at the beginning of next week. Let's get to wrapping this week and focus on what we learned from the charts. We're going to start with a poll. And thank you guys so much, as always, for responding to our polls on our YouTube channel, on our social media accounts. And we asked you recently, is the next 25% move in Bitcoin higher or lower? 78% of you agreed wholeheartedly, obviously lower, right? What's so interesting is I wonder what the results would have been different had we asked this right after the news that's hit in the last 24 hours, which is that iShares is actually filed and is formally filed for a Bitcoin ETF. iShares is one of the biggest ETF providers here in the US. Of course, some of the most liquid ETFs that we track are all iShares, provided by iShares. And so thinking about a Bitcoin ETF that is registered and managed by a well-established ETF firm, pretty attractive for Bitcoin. Let's look at the chart of Bitcoin and actually what's playing out with that as our poll question, and that is the backdrop for what's going on here. What's interesting is we're seeing a pretty decent bounce here. Bitcoin's currently up just about 3.2%. Power just above 26,000 to 26,400 as we're going live here. So what's interesting is the general trend in Bitcoin has been lower over the last 6 to 8 weeks. We sort of topped out in mid-April. Bitcoin, Ether, all rotating lower. Now, obviously, a lot of regulatory pressure. So on the negativity has really been driven, I think, more than anything, on the skepticism of the sustainability of the rally in these cryptocurrencies, or really just the suitability of these as a store of value and as an exchange of value in the marketplace. Something like today, where you have an ETF provider announcing or filing. And again, let's be clear. This is not saying there is a new ETF. This is saying they filed for an ETF. Others have filed and others have failed. So let's not draw a conclusion too much. But it is encouraging that they have a new approach that they've detailed. I'd encourage you to check out the details on it to see how this differs from some of the other ETF filings that we've seen related to cryptocurrencies. But certainly could be a promising development. Signs like this, that cryptocurrencies are becoming a little more mainstream and provide more access to more investors in a tradable vehicle, I would argue is a net huge positive, because still the rise in Bitcoin and Ethereum has been driven in a lot of ways by people outside the mainstream and not the core investors able to allocate to that sort of asset class. So we'll see if there's a little bit more to come. Interesting, this is hitting right before the weekend. We've got a long weekend with not a lot of equity trading. So we'll see if there's a bit of a rally to be had. Look to see if it gets above the 50-day moving average on the chart of Bitcoin. Thanks again for responding to that poll, by the way. Let's wrap the week continuing by looking at what happened today in the markets. The S&P down just over 1/3%, still staying above 4,400. So we finished just below 4,410. That's down about 0.3, 0.4% from yesterday's close. The NASDAQ sort of doubling that negative move, down about 0.7%. That's pushing the NASDAQ composite down below 13,700. Mid caps and small caps all down, and all three cap tiers, large, mid, and small, all right around the same, down 4.4%. So not a huge, sell-off, but of course, it's unusual. It's been unusual, certainly recently, that we've seen all the reds on the market dashboard on the front page, looking at the major equity benchmark. So let's not draw too many long-term conclusions about short-term data, but it's interesting to me here on a quad witching day. You're getting a bit of a rotation to the downside. The VIX, again, now coming lower. So yesterday we had stronger stocks, stronger VIX. Today we have the opposite, lower stocks, lower volatility. The VIX is down a full point to around 13.5. Again, the conversation I had with Sean McLaughlin on Wednesday, and if you missed that, make sure you check out all three of my guests this week. Were just fantastic. Sean McLaughlin on Wednesday, we talked all about the VIX and just the range in the VIX, how 2023 looks a lot like 2021, that slow and steady gain on lower volatility. And arguably, until that changes, this sort of slow and steady increase that we've seen is probably still in play. Day like today, maybe the beginning, but I'd have to see more of a follow-through next week. Continuing on with some other asset classes, as we look at the fixed income markets, you can see 10-year yields currently around 377. You can see the 5-year yield just below 4%, 10-year yield around 386. Short-term yields, again, still higher. So we still have that inverted yield curve, which tends to be a pretty classic sign of a recessionary period. But for today, most of the yield curve here pushing a little bit to the upside. Bond prices, of course, going down, with the TLT down about 0.4%. Dollar, not too much of a change from yesterday. Looking at the commodity space, a little bit mixed here. The DBC, which is a broader commodity ETF, up about 1.25%. Crude oil prices up about 1.5%. Natural gas up even more, about 2.5%. Copper down, silver up, and gold sort of flat for the day. If we have time here, we'll go through a couple of these. I did an interview earlier this week with Jim Poplava for the Financial Sense podcast that should be posted here very shortly. And I had a really interesting conversation about commodities and just what's happened with materials and energy, the likelihood of a rotation to the upside. And my main argument for anything like that is the proof is in the price, particularly the relative strength, which is still fairly weak for those particular sectors. Now, you can see on the little chart of Bitcoin, the spike higher we had. That's when the news hit about the iShares ETF being filed. And again, that's the filing that can take an undetermined amount of time for the regulators to actually consider and approve or not approve that sort of filing. Others, again, have filed for ETFs. What's different about this one, a little bit different structure, and it's iShares, which is a pretty well-established ETF provider with really good capabilities to hopefully give some structure and some safekeeping to that sort of asset. Looking at cryptocurrencies, as I mentioned, Bitcoin and ETH are both up about 3% today, and Bitcoin currently around 26,325. Let us continue on looking at the wrap the week chart. So we like to do this on Friday. Just look at what happened from last Friday's close to this Friday's close. So we start the clock on June 9th. We look to where we're at today. What did we learn about the markets overall over the last week? Well, first thing, the S&P having a pretty strong week. The S&P finishing the week, even with today's pullback, just briefly, overall still up 2.6% for the week, which is one of the better weeks we've seen, certainly. And again, compare it to previous, to more bear cycle years. This is a pretty strong week to the upside. In orange, that's emerging markets with about the same return for the S&P through the course of the last 5 trading days. In pink, we have the NASDAQ 100. Again, these are the leadership areas of the market that have been strong, continue to be strong. The QQQ up 3.8%. In brown here, we have crude oil. This is the USO, and it's had a nice couple days. So finishing the week up about 2.3%, getting above some of these others that it had been lagging behind through the course of the week. Bond prices up about 0.7%. In purple, we have small cap stocks up about 0.5%. Everything else was down for the week. Gold essentially flat. It was down 0.2%, so not much change from last week. Bitcoin, with the nice bounce over the last couple of days, still down about 0.6%. That's a nice recovery from midweek when it was down about 5%. The dollar, the worst performer, down about 1.2%. Again, sort of that classic relationship is a big, strong dollar has tended to dominate other assets and has been more of a risk-off field. This week, it's been a little more risk-on for sure, with leading stocks continuing to push to the upside. So nice week overall for stocks, for some other assets as well. Let's key in on a chart of the S&P 500, just see what today meant for the longer term picture. So again, higher open. We made another high, intraday high for the year, but we went below yesterday's close. And I posted a video on my YouTube channel over the last couple of days. I've had a couple really thinking about topping patterns. This one in particular was talking about technology. 3 charts that I think speak to the overextended nature of technology sector and the likelihood of a rotation to the downside, which I would say is very real. So if you want to dig more into that, go to my YouTube channel called Market Misbehavior. My most recent video, something like 3 charts that tell the bear story for technology or something like that. I most likely will turn that into an article that I'll be posting on StockCharts here in a few hours. But overall, I think the run has been exceptional, right? And the strength in the move off of the swing low in March has been impressive, particularly how we followed through after breaking through 4,200 and then breaking through 4,300. Now we're above 4,400, touching 4,450 today. So when I think about sustainability, there's 2 things you can do, right? Look at when the market is overextended, as defined by a momentum indicator like RSI, still currently overbought, which just means we've gone up a ton. The next thing would be some sort of confirmation, something like a MACD giving a sell signal, which would tell you that a rotation lower is now in play. The question then is where we pull back to. I think the short-term support's 4,300, right? A key resistance level often becomes the target of a short-term sort of switchback. So look for 4,300 as a potential support level if we would rotate lower through the course of next week. Now, further below, we have the 50-day moving average just below 4,200. I think this is sort of the ultimate level. I think as long as we remain above this trend line connecting the October and March lows, I think overall this uptrend is still pretty fair, which means you can have about a 10% drop down to around 40.50 and still be within the context of a fairly consistent bull market. Now, that's what we've seen right now with the chart of gold here, because when you think about gold, this is a trend that's been overall very strong. However, we're now at the lower end of that channel, and arguably we may be bouncing higher here. We've broken below the trend line channel, but we're now holding $180 on the GLD. Lines up pretty well with the January rally, the January-February peak. Can this hold? So I think a number of these things have pulled back, like gold. Are they holding support? Things like the S&P have not pulled back yet, but if and when they do, I think we have some ideas about a potential downside objective. Let's take a quick commercial break and we'll be back answering your questions from the Final Bar mailbag. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. I'm your host, Dave Keller, here at StockCharts.com. Thanks so much for joining us every weekday after the close. We have a lot of great stuff planned for you on StockCharts TV over the coming weeks and months. Excited to share it all with you here very soon. Couple of quick announcements before we open the mailbag, and the main one is we love your questions. We love hearing feedback on our channel, on our shows, on your host, but especially we love hearing your questions. What are you running into as you are trying to analyze the markets using the Technical Analysis Toolkit and using the StockCharts platform? Our email is thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV. And if you're on our YouTube channel, just drop a question below the video you're watching. We'd love to hear from you. Hope to answer your question in our next mailbag segment on Tuesday of next week. Let's continue on today and open up that mailbag. All of these questions, again, have come from viewers like you over the last couple of days. Appreciate you. Keep the questions coming. Let's get to question number 1. Dave, what scan would you use on StockCharts to identify shorting opportunities? What's so interesting about this question, by the way, is I love when I get questions like this, right? There's only certain times when you get questions about shorting. And it's either when things start really accelerating to the downside and there is sheer panic, or when things have been running so hard, which is how I would describe the current market environment in June of 2023, that people are now starting to question, I think very rightly so, exactly how far is this run going to go before we really want to start thinking about downside potential. And again, I think that's a fair question to think about how you can protect yourself, thinking about some of those different bear scenarios, what it would look like from here, and think about where you would need to take some risk off the table. Focus on keeping your stops updated while the market is still fairly elevated as it is right now. So what scans would I use? And I appreciate the question. The scanning engine is tough to get into too much detail just because it can become pretty complex depending on how crazy you want to do it. So I'll show you some really basic ideas. And what I'm going to do is you can build these scans from scratch. I like to go to the predefined scan. So if you go to the charts and tools at the top of our website on the right, you will see, let's see, sample scan library predefined scans. We're going to start here. And I'll show you the other one in a second as well. So basically, we have a bunch of predefined scans, some scans that we are running every day. We update them during the trading day, and we post the results here. Now, the intention of these are common things that we had people looking for, so we built them and we just keep them updated. You're welcome to analyze them and use them anytime. But what you can also do as a StockCharts member is take one of these scans, copy it to our advanced scan engine, and then start to edit it. So if you want to look at the scan, but focus it just on the S&P 500 members or just on technology and communication services as two particular sectors, or you want to look for buy ideas in energy and materials, you can take these predefined scans and then start to make them your own by adding additional criteria, refining the criteria a little bit. But as I was first learning the StockCharts scan engine, this was a really good starting point because you can understand the syntax and just see what the capabilities are. And I think that can be pretty powerful. So, one quick example I would tell you is look at when things have been strong and are starting to rotate lower. And that would be something like a bearish MACD crossover. If you click on this, what this is going to be is, and actually, I'm not, it's going to be a little hard to see this on. No, here we go. So we bring on this, I was going to say, I know there's a way to get to it. If you click on the scan and here where it says edit scan criteria, this will actually show you the language in our scanning engine that creates that, because it's basically doing a bunch of if-then statements. So doing a bunch of little comparisons to, to actually quantify the signal that you're looking for. Now, if you are more of an engineer, programmer type, and you love knowing and understanding this syntax, have at it. You are welcome to it. And of course, at the bottom, you can add different arguments and hit add, and it will put the syntax up here, and you can edit it. And then just make sure you check it before you run it just to make sure it's going to run effectively. I am not a developer or a programmer, but I find the scan engine incredibly powerful. And the way I do it is by starting to just use these schedule scans, take those scan criteria, and then add my own capabilities. So one idea would be bearish MACD crossover. So these are charts that have been very strong and are now starting to rotate lower a little bit. So this, looking at the MACD indicator, this is the QQQ, but it's basically going to be showing you these kind of charts. Look in August of last year, look in December of last year, look in February of this year, in April. This is when a market has had a pretty good run and then starts to rotate lower, right? So it's not going to, predict. It's not going to happen before the top. It's actually more of a lagging indicator. But I found good shorting opportunities usually tell you when they're rotating, right? It's not enough for a stock to still be going higher. A lot of times I like to wait for a rotation lower. And in MACD sell signal, you can see there's a lot of room left on the downside. Even during a bull phase, there's a lot of a drawdown that could be a tradable drawdown if you're more on the swing trading time frame. So that's one thing I might suggest you look at. I'll go to my scans because another one, that's not what I want to look at. I want to go to the dashboard. I'm going to look at the scans here, and I'll pick one of them because I have one that was just RSI overbought, which is one of my basic scans that I run all the time. So this scan right here is basically saying, look at the S&P 500 members, tell me all the stocks with an RSI above 70. Now, are these stocks that are going down? No, not necessarily. These are actually stocks where the trend is positive. But this is the watch list that I start with. There are currently, as of today's close, 56 S&P members, about 10% of the index that's actually overbought right now. These are the names that I will look at to see when they are no longer overbought. Put these on a list and then set an alert when any of these stocks start to break down below the 70 level. That's when it tells you that it had been in an uptrend, and now that uptrend is starting to be alleviated. So I think that's another way to think about it. Look for stocks that are overbought, that are still doing strong, and identify those levels or identify the signal that might tell you when that uptrend is no longer valid. Final thing that I would look at, and again, I'm more of a trend follower than anything, as you probably can tell from the types of charts that I like and the ones that I don't. I like to look for stocks making new 3-month swing highs. I also like to look for stocks making new 3-month swing lows. Now, these could be stocks that have already been going down quite a bit. This is a healthcare name called AGL, which you may or may not be familiar with. It's a mid-cap healthcare name. But I like looking at stocks making a new 3-month low, because what that tells you is not only is it no longer going up, not only is it rotating lower, but it's starting to break down through support levels. And it doesn't necessarily, that scan on its own doesn't tell me to short it. What it does is it gives me a working list of stocks to start to filter through. I think there's different ways to think about scanning for ideas. One is come up with your perfect criteria and then scan for that sort of holy grail combination. And I think there's an argument to be had there. I like to keep my scans a little more general, come up with a working list of stocks that I think could be pretty close to the charts I want to find. And then I like to go through them manually and look for the visual cues that confirm to me that this is an actionable trade. So those are three ideas using RSI, MACD, and just looking simply for 3-month lows. I'd encourage you to experiment with our scanning engine. And also there is by the way, go to Charts and Tools. We have a new area called the Sample Scan Library. And if you've not checked this out, Grayson Rose has been driving this one. Asked me for some ideas, which we've been peppering in there. There's a lot of really cool scans that we've started to incorporate that could be good actionable ideas for you as well. Next question. What does AI say about the best indicators to use in timing when to buy and sell a stock? I love that question so much. And I will tell you, it's not as straightforward as you might think. So I've had a lot of discussions. While it feels like AI has in some ways come out of nowhere, certainly the AI trade has exploded. The idea of using deep learning and machine learning and automation and AI sort of tools to automate some of the tools of the analyst or of the trader is a well-trodden path for decades now, and just the technology has gotten better. But I remember talking 10 years ago with Kevin Moore, who's a professor down at Texas A&M University, and we talked about modeling and AI and machine learning, and how the way that I generally thought of it is with a quantitative model. If you're creating a model, you're basically telling the machine what to do, and then the machine starts giving you the results. These are all the stocks that fit the criteria. The scan engine is a simple example of a quantitative model that you're basically creating. It just automates that process. What AI and think about machine learning, what basically is, instead of giving the particular recipe, you give the menu. Here are all the ingredients you can use. Here are all the utensils we have in the kitchen. Make me something interesting. And you are allowing the computer to figure out the combination. Here's the thing, though. The model is only as good as the data you give it. And what I found a lot of times with AI, where they think, well, obviously this is going to overtake human decision-making in investing, that has been something we've been talking about, and it just still is not the case, because the computer is only as good as the data you give it. And a lot of times what happens in the financial markets, you have really unusual things that happen. Go back to long-term capital management as an early example of modeling that doesn't match reality very well. And I would say the second thing to remember is anytime you're modeling, any automation that you do is only as good as the model, right? The model is not reality. It's an estimation of reality, which means you have to make some assumptions. Sometimes those assumptions don't prove particularly well. AI loves to make up data. That's been a big issue with ChatGPT recently, is all of a sudden it makes up, research reports and then talks about them because it thinks that's what you want it to do. And we're finding that too with simple AI models that I've seen for stock picking. It makes things up, makes up data that's not really there in an attempt to actually get you to where you're trying to get it. Finally, what I would say is AIEQ is an ETF that is driven by an AI engine to try to pick stocks. And if you look at the bottom, you can see the relative performance of this cutting edge AI model designed to pick stocks. So the game is not as easy of all we need to do is turn this computer on and I bet it'll figure it out. There is potential there, but it is not as close as it probably seems from the AI news we've seen recently. Final question here. Please discuss the volatility contraction pattern, or VCP. How prevalent and powerful is that pattern? If you've not heard of the volatility contraction pattern, this is something Mark Minervini, who's a frequent trading champion and an expert marketer, in my opinion, has popularized this particular idea of the volatility contraction pattern. And again, I think it's a brilliant marketing exercise. I don't disagree with how he portrays it. He basically talks about it as what I would describe as sort of the calm before the storm. We'll look at something like IPG, which is a stock that recently had a coil pattern, right? You had the rally, and then you had lower highs, higher lows, sort of this consolidation phase. Anytime you've heard me on the show say consolidation phase, that's basically what Mark is getting to with his volatility contraction pattern. It's not its own pattern. It is not a special technical indicator you've not probably heard about before. It is a general way of describing things like coil patterns, triangle patterns, cup and handle patterns, flag patterns. Anytime there's a move and then a consolidation, a contraction, where the volatility comes in and the price starts to set into an equilibrium. His way of describing that is basically labeling these types of patterns where there's been a move, and then there's this quiet period, and it's basically setting up for a big move higher. Mark did not, create this idea. People like John Bollinger and many before that, go back to Edwards and McGee, they talked about that, the basing patterns and the breakouts and how important volume is in those sort of patterns. But I think Mark has done a great job of just describing them generally as the way that the consistent theme across those is the fact that volatility is coming in, and looking for patterns of high volatility to low volatility and thinking of those as a setup, waiting for the trigger as to when it breaks out of that, I think is absolutely 100% agreeable. So I like the idea of it. And again, it's just a general way of describing some of those patterns you probably already know. Consolidation patterns really getting ready to break out. And that's one of the things that makes a chart like IPG kind of bullish, when it breaks out of that volatility contraction pattern to the upside. Great questions, by the way. We have a lot more in the mailbag. We'll keep the mailbag going in the next week and coming weeks. But for now, we have to wrap the show, folks, and go to the 3 and 3. Let's talk about 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. I want to start with my market trend model. When we wrapped the week, we just had to talk about the strength in this week. The S&P up over 2.5%, a nice follow through. And a lot of the questions I got from media outlets this week in interviews was all about, is that it, right? I mean, how do we know when a top has happened? And I would sort of give them 2 things. Number one, there's no denying we are overextended. And by any measure I would do, by price momentum, by breadth characteristics, by just movements away from a mean price, percent above a moving average, all of those tell you the market has had an incredible run already. The second thing, though, and a very important thing to look for, are signs that the rotation is beginning. And that's what I don't think we have seen really yet in any meaningful way. You're seeing little bits and pieces, a random bearish momentum divergence, but not to the scale that it seems like a really obvious rotation lower. I think going into next week, watching some of those leading names like Apple and Microsoft, top ranked names in our scooter rankings, like NVIDIA, like PLTR, to see if you start to get that rotation, see if you make a new high on lower volatility. That's what would tell me to start to really get concerned. But for now, the trend is positive. And the way I define that is with my market trend model on a long-term, medium-term, and short-term basis. Yet again this week, all thumbs up, all bullish. Gold is chart number 2. The GLD has bounced off of 180, and it basically found that at the end of May, and now a couple more times has bounced off of that support level. It's interesting to me because it lines up with the January high. What's really interesting about this chart is if you look at the rally into the August peak of last year, we then made a new low for the year, retested it as resistance, broke above, and then tested it from above. And we bounced off of that, call it 167, 168 level before rotating higher. We've now done that same pattern, the January peak, the breakout, and now the retest. I'd be very keen to see if 180 holds. And if so, this could be a really interesting setup. Gold is more of a defensive play, so I could see leading growth stocks struggling a bit or pulling back, something like gold really taking its place in a position of leadership. Chart number 3, let's go to Candlestick 101. The question is, what is this candle pattern? I'll give you 5 seconds. 4, 3, 2, 1. It is the dark cloud cover candle. The dark cloud cover candle is basically a 2-candle pattern where you have an uptrend, you have a rally, a big open candle, meaning we opened at the lows, we closed up toward the highs. We have a higher open and a lower close. And the key part is this: the close of day 2 has to be at least 50% of the way down through the open or through the body of day 1. That's called a dark cloud cover. If this would happen at a bottom, if you see a big down day and then an up day that went at least 50% more, that would be called a bullish piercing line. If you think about it, if this would go a little bit further and close down around 210, that would be a bearish engulfing pattern. In either case, it is not bullish. Folks, that's a wrap for the show. Thanks so much for joining us all week. We'll be off on Monday for the Juneteenth holiday. We have a special episode focusing on what makes a good-looking chart. Have a great weekend. We'll see you next week on The Final Bar.